Are you prepared for the biggest tax changes in decades? The so-called One Big Beautiful Bill just got signed into law. So if you are retired, own a business, have stock compensation, or are thinking about estate planning, you need to listen to this episode because your taxes are going to change dramatically. In this video, I'm breaking down how these tax law changes are going to affect most of our financial planning clients. We're going to look at the 4 key areas that we think are most relevant. We'll cover what's changing, when it takes effect, and most importantly, what it means to you. And make sure to stay to the end because I'll show you how to get a visual breakdown that makes all this more clear. First up, we're going to talk about how this impacts people who are retired. There's 3 main items I want to call out. The first one is a boost in the increase of the standard deduction. Retirees are going to be getting relief with an increase of $15,750 for singles and $31,500 for married filing jointly. But here's the big win. If you're over age 65 and you have income under $75,000 for single filers and $150 for married filers, you'll get an additional $6,000 up through 2028. So for a concrete example of that, if you're married filing jointly, over age 65, have under $150,000 of income, you'll get a standard deduction of $46,000. Now that's a whopping $12,900 more than last year, 2024. Next up, big impact on retired people is tax bracket certainty. We've all been concerned about tax brackets sunsetting to the prior levels, but now those tax bracket increases that were scheduled for 2026 are gone. Your current rates are going to remain in place as permanent. Well, as permanent as tax code can actually be, but either way, it should give you more certainty in how you're planning for your financial planning strategies in the future. The third big item that affects retirees and higher earners without a lot of deductions would be the increase in the SALT deduction. Now, SALT stands for state and local tax deduction. This had been capped at $10,000, but now it's increasing to $40,000 through 2029, and then it's going to drop back down again to $10,000. The one caveat is that for higher earners over $500,000 a year, you do start to see a phase out in how much they can take of this deduction, but it's still an improvement over the prior tax law. So if you're in a state with high income taxes, pay attention. This is going to save you a lot of money in the coming year. So the planning opportunities for retirees would be to consider increasing Roth conversions while you still have your senior deduction, plan major expenses while you still have a larger SALT deduction before it drops in 2030, and consider your state tax strategy if you're considering relocation. Area number 2 of this bill affects stock compensation, specifically when it comes to qualified small business stock and the AMT Relief. For the QSBS, qualified small business stock, this is a pretty revolutionary change. We're actually going to move from a 5-year holding period down to a 3-year holding period requirement. There's phased benefits of 50% at 3 years, 75% at 4 years, and 100% at 5 years. And while the holding period dropping from 5 years to 3 years is a big deal, I think even bigger is that the exclusion amount jumps from 10 million to 15 million, and qualifying companies can now have up to 75 million in assets versus the prior 50 million. So as a small business owner, this QSBS changes are pretty transformational. Not only do you have a shorter period to get on with faster exits, you can also support larger exits and you can grow larger before you lose QSBS status. Now, the second part of the bill that has to do with stock compensation that we find relevant for clients is the AMT Relief. We now have permanent higher extensions where we have modified phase-out thresholds of $500,000 for single and $1 million for joint. This reduces AMT triggers, meaning fewer people are going to get caught in the AMT trap when they're exercising incentive stock options and other stock compensation. So the planning opportunities as part of this bill change that comes to stock compensation would be the shortened QSBS holding period that's going to accelerate exit planning strategy. You also need to review your ISO exercise strategy in light of the improved AMT rules. And consider accelerating your QSBS if you're approaching the new limits. Point number 3, when it comes to business owners, we're going to focus just on the changes with QBI becoming permanent. There's actually a number of issues that are improved for small business owners, but it's enough for a whole video. So this is the main call out I want to make here because it affects a lot of our clients. The 20% qualified business income deduction is now made permanent with expanded eligibility. Phase-ins increase to $75,000 for single incomes and $150,000 for married incomes. The planning opportunity is that at least now we know this is permanent and you can make some strategy for long term. You need to definitely structure your business to qualify for this QBI deduction. And if you're considering selling, the QSBS changes may accelerate your timeline while maximizing your benefits. All right, area number 4 of the bill that we think affects a lot of our clients is the way it impacts estate planning. The big headline item is the massive increase in estate tax exemptions. The estate tax exemption permanently increases to a $15 million level per person, and that's $30 million for a couple. This starts in 2026 and then is indexed for inflation afterwards. The same $15 million amounts are applied to generation skipping tax, which opens up a lot of multi-generational gifting strategies. The main idea here is that there's permanence with these changes. Again, at least as much as tax permanence can be a thing, but not having the sunset provisions gives some more certainty around advanced estate planning and tax situations. So the planning opportunities around estate would include revisiting your current estate plan immediately based on these changes. Consider larger lifetime gifts. You're going to want to evaluate different trust structures, and some of you will have more comfort pursuing more advanced strategies such as GRATs, grantor retained annuity trusts, and intentionally defective grantor trusts, which still worked before, but it's just more certainty today. So to recap, the One Big Beautiful Bill provides a lot more tax certainty for retirees, expands the opportunity for qualified business stock deductions, provides some relief to those that may have been subject to AMT, and greatly expands the estate planning tax exemptions. So these aren't just tax changes, these are opportunities that could save you thousands if you plan for them correctly. Don't let these opportunities pass you by. And remember, at the beginning, I told you I'd have a visual you could download in the comments below, built out as a mind map that can explain these concepts very simply and make them easy to understand. It's a visual guide for everything we discussed today. If you found this video helpful, please like and subscribe, and check out our other content on retirement, tax savings, and investment strategies. And remember, financial freedom takes more than money, so make a plan to live your life well. Take care of each other out there.
Investment advisory services offered through Savvy Advisors, Inc. Other entities and/or marketing names, products, or services mentioned here are independent of Savvy Advisors, Inc.